Excellent.
Perfect.
Okay, so it's now 2 minutes past 4, so I think we can start. So it's a pleasure introducing you to Mauricio Elizalde. Mauricio Elizalde did his degree in mathematics at UNAM, the National Autonomous University of Mexico, located in the city of Mexico. And then he moved to Madrid, and he did this his master thesis in mathematics at the Department of Mathematics of the Autonomous University of Madrid. And then he started his PhD under my supervision. And this was, well, correct me if I'm wrong, almost 6 years ago when you started, Mauricio. And yeah, during all this time, he has been both working on his PhD and also working in a private company, in a trading company, Arfima, as a quant researcher. And in this seminar, Mauricio will tell us, well, what he has been doing these years of PhD studies, both in Madrid and also in his stays in the WPI and UCSB, being advised by Professor Stefan Storm in WPI and Professor Tomoyuki Chiba at UCSB. So please, Mauricio.
Thank you very much, Carlos. Thank you for a nice presentation. Well, we met 6 years ago when I was your master's student, and I started 5 years ago the PhD. So yes, we have worked 5 years in these topics. Very nice topics, because I had the opportunity to visit Professor Storm, who is with us in this seminar, and Tomoyuki Shiba, who couldn't come. And well, I take the opportunity to thank Carlos for their patience and his very nice supervision in this huge work. So well, first of all, there are many topics in the thesis. I can separate them in both topics, in 2 topics. Both of them has some parts. In fact, the first part has many sections. So sorry, because I have to. This presentation is only the tip of the iceberg. I have to go quickly and skip some definition and computations. But well, the organization is as follows. The thesis deals with the problem of optimizing portfolios with target information. I work with that in 2 contexts. First of them is with insider information, where we assume the trader has privileged information, and we perform an anticipated portfolio optimization. In this case, we cannot use the stochastic partial differential equations as usual with Ito calculus. So we use Russo-Valois forward integration and the Skorokhod integration, which allows anticipative integrands. And the other topic is what about if I have target consumption preferences in an intertemporal consumption problem. So here the investor models the intertemporary consumption with these target distributions with which model has preferences, and seek for a strategy with the lowest cost. This cost has to be adapted to such preference. So that's the part, the issue here. Well, let's start with the anticipative portfolio optimization part. Here we perform the portfolio optimization with a portfolio with 2 assets. This is the first point. Later on, we add more assets to the problem. Well, we have a risky asset and a risk-free asset. Every asset with their dynamics, since the risk-free asset is deterministic, we don't have a stochastic part, and so we have it in the risky asset. Well, here BT is the driving Brownian motion, and as usual, mu is the appreciation rate, sigma is the volatility, and RT is the risk free rate. Well, let pi be the proportion of the wealth invested in the stock. So here we can see that we multiply by p the SDE regard to the stochastic differential equation with which this stochastic, and 1 minus pi with the, well, it's not a stochastic, this equation, but this deterministic equation. And well, we work with that. If we work with Ito calculus, Merton determines that the optimal portfolio has this shape. That is like shape ratio. Sometimes we call this Merton ratio. It's like the shape ratio but with an squared volatility here. And the value of the problem, since we are optimizing the portfolio with utility, assuming that we have an utility logarithmic function to model the risk aversion, the value of the problem is the expected value of that utility function, that is the logarithm of the wealth at time t, at the horizon time t. And as a result, we have the expected value of the integral of this term. And this term, as you see, is the risk-free rate plus 1/2 the squared Sharpe ratio. And I make emphasis on this because this is the shape we find later on with the optimization with forward integral and Skorokhod integral, but with extra terms. Okay. Well, we started to work in this because Carlos Escudero worked with an approach with a single period problem, but a very, very important assumption is that not considering any utility function. So we assume that the trader is not risk averse here. And well, the strategy is invest every, the total amount of your wealth in the stock if at the horizon time the stock will be greater than the wealth of the risk-free asset, and otherwise invest the rest of all your money in the risk-free asset. That could be a bank account or a bond. Well, and which is the expected wealth of this time t? while the problem is ill-posed if we use it's a stochastic differential equation, but so we can use Skorohod stochastic differential equation or forward stochastic differential equation, and he proves in this work that one of the theorems is that if we denote but x HO for the stands for the honest trader, S A for the Skorohod integration of FW forward integration, he proves that the wealth obtained by the trader, the honest trader, is greater than the one of the Skorohods is using Skorohod integration, but less than the wealth obtained for the forward trader. So this is important because the conclusion is that with these assumptions, the Skorohod, we were using Skorohod integration has not financial, is not financially meaningful here. And obviously what has financial meaning is to use forward integration because we assume, or we can assume that the trader that has more information must have more wealth. Well, let me skip some definitions. Well, before that, we try to now see what happens and get comparisons, but using utility logarithmic function and with our self-financial portfolio, so we can reinvest at every moment. And to model that, I use the Skorohod integral, and to solve the Skorohod integral, I use anticipative Girsanov transformations, and to get closed form solutions of that. Later on, I have to assume that I use constant parameters in sigma, mu, and the portfolio. I use the forward integral and the Tonsker delta function. That is a tool I can use to compute some expectations. Well, let's start with using forward integration, but with adapted parameters to start to work up with the problem. So we assume that the wealth of the trader has this form as we stated before, but with the forward integration process. And I use here BEDT is a Brownian bridge constructed from a standard Wiener process, and but with rules of Alba forward integration. Here I apply the well, first the solution. I compute the solution, and I take the expectation of this integral. In this solution, I take the logarithm form, and I don't have here the initial term. I assume that the initial condition is constant, and meanwhile I using the logarithm utility function. For convenience, I used the initial condition as 1, so x0 is equal to 1, and when I apply logarithm is 0, so the initial term doesn't appear. And when I take the expectation of this integral, the right-hand side of this equation is 0 because forward and square integrals coincide with e to 1 when the parameters are adapted. So the expectation of the integral is 0. And I take the expectation of that integral. So in this case, I maximize the integral to see the solution. And the solution in this case is very similar to the Merton ratio, to the Merton case, but with an extra term. And this term, we can see this term as the value. So let me make the emphasis that here B is the final term of the Brownian bridge. So this is the final term of my driving Brownian motion minus the expected value of this driving Brownian motion at time t. And this is divided minus the final time minus t. So this is like slope and weighted by the volatility. And the value of the problem is an integral similar than before, the risk-free rate, plus 1/2 the square Sharpe ratio, but adding this correction term, that this correction terms comes from my additional information. Well, what happens if I allow to have non-adapted parameters? So the filtration I use is not the usual filtration, that is the natural filtration of the Brownian motion. So here I use the natural filtration of the Brownian motion plus or adding the knowledge of the time t. I mean, I enlarge this filtration with the sigma algebra generated by this random variable at time t. That is the linear process at time t. So my computations that start being the same, but in the time I compute the expectation of this integral, here this integral is not 0, but I have to apply a property between the the forward integral and the Malevin derivative. So I can compute the expected value of this integral as the expected value of a deterministic integral, but in terms of the Malevin derivative. So I have to compute this integral, and I use this tool I mentioned before, that is the don't scare delta function. So I have I can compute these kind of terms as here. I use by a moment pi as a function of s, and my random variable from I have information, and well, once I apply the property of the delta don't scare function, I have that my the value of the optimal portfolio is this is the optimal portfolio, and is this term plus this term is very close to the previous one, but I have here not expected value, but the current value of the Brownian bridge. So the value of the problem has this extra term, similar that the previous one, but with this extra term. Okay, then we continue with the Skorokhod integration method, where I use a similar Brownian bridge, but with Skorokhod integration. So in this case, I have that the value of the problem is the expected value of this integral, and the advantage of the Skorokhod integration is that the expected value of an Skorokhod integral is 0 as Ito, but so I can compute the solutions. I have to use anticipative Grierson transformations, and let's start with a deterministic case. In the thesis, we start with a where the parameters could be stochastic, but the problem has the solution has not a closed form, so we relax the constraint. First, let them to be deterministic, but in this case, to solve the equation, we have to compute the first variation of the value of the problem, and see that there are some constraints that leads B to be this form. So the unique solution under the deterministic case where I allow the parameters be dependent on time is with this very value of B. So the solution is with this extra term with B, where B is an integral depending on the sharp ratio in the negative sharp ratio, allowing it to change in time. Well, but this is for a specific value of B, but I want to B to be free. So let's relax the condition and the parameters. What happens if now they are constant? If we allow them constant to be constant, we can compute a closed form solution, and the expected value of the logarithm has this closed form that is linear equation with respect to B, and then I can maximize it. If I let pi to be free, well, obviously the maximum and the minimum will be minus infinity and infinity, but if I put constraints over pi, I'll let it to be in between 0 and 1. In the case, we study the cases, and when B is minus the sharp ratio times capital T, pi is equal to 1, and the value of the problem is this. And when B is less than or equal to minus sharp ratio capital T, then pi is 0, and we have only that the value of the problem is the risk rate multiplied by the capital T. And so we can express pi with this indicative function depending on B, and the value of the problem is this. Now the value of the problem has changed, but we can compare what happens with this and the Merton case and the forward case. Well, to compare, as we could only solve this Korhol equation in a closed form with constant parameters, we consider the case of when parameters are constant. And we found that the Korhol insider overcome the 411. And for in transitivity property, the score of host 1 overcomes also the ordinary trader. That is an interesting conclusion. Well, this is the computations where we see we conclude. Well, let's explain every case. When B is less than minus the Sharpe ratio capital T, the value of the problem, we using the square of hot and forward are equal. Well, this is assuming that the Sharpe ratio is positive, which is a financially meaningful condition, because we expect that the stock return rate is bigger than the risk-free rate, and well, this is we are assuming in all of this that we are long in the we are buying the stock. We can that is analogous if we allow to sell, but we only the strategy is buy and hold, and so that's why it's meaningful to assume that Sharpe ratio is positive. And in this case, in the case that beta is less than this bound, the ordinary investor overcomes the insider ones. So we have to ask B to be bigger than this boundary to have that that the insider ones overcomes the ordinary one, and we have that the value of the problem with the square hot is bigger than the value of the problem with forward in the forward case. And well, we analyzed it with different intervals of B, where we have the same results. I have an example, a real example, assuming that we have inside information. I mean, the real part of this is the path of the 2-year US Treasury not future, which is not real, is that we have insider information. But I have to mention that the term insider start with being related to illegal information. But nowadays, these topics have more applications with people that has better information or that are better informed than the other ones. So I don't have to have legal information, but maybe to have better information to analyze better the information, to buy information. So I only want to emphasize that it has not to be illegal. But well, in this case, I perform this, assuming that I know the value of the. Obviously, I waited to know this value and apply a backward analysis. So here we can see this is the wealth evolutions, and what we have is that the wealth of the score of a trader is bigger than the one of the forward trader, and both of them has more wealth than the ordinary trader. And we not only do this with a real stock, but with simulations and letting be any number. And I make a lot of, I think, 100 values of B taken from a normal distribution that has have mean 1 and standard deviation 64. Why 64? Because I wanted to compare this with the 2-year Treasury futures, and I take it here 64 days to perform this. And then the results, it has that if I compute the histogram of the value of the problem, I have that that in mean the square host value is bigger than the forwards, and the standard deviation is slightly smaller than the forward value under, well, the value of the forward integration. So, well, this is interesting because numerically we see that in terms of mean and variance is better to perform this with square host integral. That's interesting because if you remember at the beginning of the presentation, we say that without the without risk aversion, taking the square root integral is not financially meaningful. And here, not only is financially meaningful, but it's better that considering the forward integral, right? Well, in this part of the simulations, and the next part I will present very quickly, I work with it with Tomoyuki Ishiba in Santa Barbara, where we extend the theory of portfolio optimization with to multiple assets. Well, the assets could be related or not. We model the dependency within them through a volatility matrix with a Gaussian volatility matrix. And we assume the parameters be adapted to I can compare and make generalizations. Well, I try to pass very quick this part, but this is the, let me present the notation I use here. I assume that the risk, I have the risky assets. Every asset Sj has the following stochastic differential equation, where everyone has their slope and have these terms that come from the volatility matrix of the stock. So they could be correlated or not. If they are not correlated, every term sigma I j would be 0 if I and j are different. So for the matrix notation, I used these column vectors, and I use this notation to take the Brownian motion as a vector. And well, I can skip this part. For the generalized Brownian bridge, where the final value of the Brownian bridge, which is B, well, from that I take a vector B. Now I have B bar. Well, this is from this we deal with assumptions, and we have to assume interoperability of them. And here I use an important property that I took from them book or from Nolart, that this is the Ito formula from multiple assets. So when I use, let me lead you to the forward integration method. Everything looks more or less the same that where with one asset, but here I applied Ito's lemma for multiple assets, and then I have a similar expression of the one asset case, but with the using the Euclidean norm of this product. This Euclidean norm will appear in the expected value, and so to maximize this, I use the gradient of the integrand and check that pi satisfy this equation. That this part is the multiple assets for the Merton part, and here is the correction part that looks like the previous one with a vector and matrix notation. And I compute the value of the problem of this. That is the similar of the previous part, but with this extra term in the squares Euclidean norm. And well, using square of integration method, well, I did the computations very carefully to check that everything match with the matrix and the vector I working on. And at the end, let me show you that for pi, every entry of every component of the vector pi satisfy this, which is similar to the constraint with pi in the one asset case. And as a shorthand notation, I use this where I ask to be bigger than minus in the, if you remember, in the one asset case, I multiply the Sharpe ratio multiplied by the capital T. Well, here I don't have sigma as the denominator, but multiplied by b bar. So the value of the problem here is this, where I have it here, and this, well, here I assume, if I assume that this constraint is fulfilled, that is not a very extreme constraint, is that b bar, or is like the every b is bigger than the correspondent Sharpe ratio, but taking into account in this multiplication extra terms that have the form sigma j and bj. And if I have that, then the value of the square of the integration is bigger than the value of the forward integration. So that's the generalization. And well, to end with this first part, we studied the performance of two investors, the honest trader and the insider trader on the forward integration. Why forward? Because in forward integration, we have a closed form solution with the deterministic parameters. And we see that the probability that the honest trader gets a higher logarithmic utility and therefore more wealth than the insider is strictly positive. So it's not the case. Intuitively, the insider must overcome the honest one. And in expected value, that's the case. But we see the paths. There are some paths that make the probability that the honest wins is strictly positive, and we computed that. Well, this is let me see the expression. The expression of the logarithmic utility. This is take it the forward insider. The probability that this overcomes the log insider. We compute this with through a boundary because it was the expression of the probabilities overwent. So it's better to compute and has a closed form solution if we compute a low boundary. And we studied the behavior of that low boundary. And we conclude with this that there may be utility, the logarithm utility is maybe too conservative for insider traders. And with this, I conclude the first part. And the second part, let me see what I think. I hope I can present it in 10 minutes. Well, this part comes from a problem about how to make an optimal consumption investing given a budget. So I have a budget, but in this case, I try to not to using utility functions. There are some criticisms about using them and trying to estimate the utility functions. I mean, not to use them, so to use the classical utility functions, assuming that they are concave, for example, and to try to get a closed form solutions. And they are very, very difficult to do it in practice. So why not? Let's see if I had this. Why not do this? In the classical utility-based portfolio optimization, we have this. I have a budget, prices that grows in the market, and preferences that here I model the risk aversion, for example, with a utility function, and that as a result, I have a distribution. Like in the previous part, I have the value of the problem, and that value of the problem has an expected value and a variance. And as I showed you on the histogram, but I have a distribution. Well, what happened if now I model the problem with a budget prices, but now using that distribution as a target information, and information I use as an input. So I can I can set the expected value. Well, I mean the distribution I want to consume. And with that, I can compute my risk aversion, for example. But in this case, well, let's start with an approach Sharp et al. Developed, which is an interactive tool named the Distribution Builder, that is like a Tetris, where the pieces represent the outcomes, the possible outcomes of a retirement investment. And people were told that 75% of the retirement is a base and represents the risk-free or a risk-free asset. What happens if I invest for my retirement through a risk-free asset, and I have this for sure. Now, people are allowed to put the possible outcomes according to their preferences. Obviously, they prefer to get more wealth, but if I put many pieces above the reference line, my budget will be bigger. So I have a budget as a constraint. So if I put many outcomes above the line, so I have to put outcomes below them. And well, they have a study where people use this, and as a result, they have a distribution preference that is a log normal distribution. In that case, that doesn't have to be a log normal distribution every time. So what happened with that? Well, with that, a model, in fact, I modeled a single period approach of this consumption problem. And in fact, when the problem is easier with one period, because we have to solve this equation. Oh, well, this expression, this is the expression for the minimum cost problem in an equiprobable space where X is represent the outcomes of my consumption random variable, and psi is the price kernel, that is the state price process, or the stochastic discount factor and of every outcome. And to solve this, I proved that is only necessary to apply that automatic anti-commotonic property condition that it says that two random variables are commotonic if they grows at the same sign. So they are anti-commutative and anti-commotonic if X and minus Y are commotone. So what it says that if one random variable increase, the other one decreases. Well, this is for one single period. If we do it with many periods, as a naive approach, we can say, well, we apply this approach n times, but this is not sensible and doesn't allow to define a dependent structure between my consumptions. So we propose a sophisticated way to add this dependency structure via copulas. And copulas are random vectors with marginal cumulative distribution functions. So we can describe the intercorrelation between the random variables. And here, every distribution function of the random variables of the consumptions is uniform. Well, in fact, we use Clayton copulas because they are practical, and they have only one parameter, that is alpha. And alpha runs between -1 and infinity. And if it is closer than -1, the random variables are negative correlated. Around 0, they are not correlated, are independent. And if alpha tends to infinity, they are positively correlated. So we design an algorithm to considering n states of the market, and assuming that there exists a price kernel at each time k. So as stated before, we have to minimize this expression, the expected value of the cost of the consumptions. Well, here I assume that I have a capital N periods, and we perform the algorithm in 3 steps. We simulate the state price process. That is not easy. We have an example with Black-Scholes model, but with CEV model, we have to compute it numerically because it's not easy to solve them. And in fact, we have to use Laplace transform and inverse Laplace transform to have the expressions theoretically. And we simulate the observation of the consumption distribution, and generated the t is the time horizon time, and we take n capital N values of that. So we simulate n consumption vectors, and from these vectors we compute the distribution, the consumptions using a distribution we want. We assume that the agent want to consume in a log normal way every period to make the computations easier. And well, we demonstrate that if we compute in anti-monotonic way the sum of that random variables in an anti-monotonic way with the state price process, we achieve the minimum cost of the problem. And let me show quickly numerical implementations under Black-Scholes model, where we use a Clayton copula, and assuming, as I said, log normal distributions. So here the state price process is computable in a closed form, and we set n equal to 10 periods, and we see that for negative values of alpha is the parameter of the Clayton copula, the standard deviation of the log normal distribution is inversely proportional to the cost. And for positive values, the relation is proportional. Let me show you here in this graph. What I have is, if I choose a bigger standard deviations, I have less cost of the problem. And we can see here, let me take a slice of this. I we can see that for positive values of alpha, the cost is less. So we make this this plot that we call cost efficient frontier with alpha equal to 5 and alpha equal to 10, where we see that with more standard deviation, we can see from both ways. Here, with more standard deviation, I have less cost with fixing the expected returns of the of the consumption I wanted, or if I fix the budget, for example, $1,000 or 1,000 euros. Here, what I expected per period increase if I accept more standard deviation. That is this the classical form of fan utility function. And well, we finally compute a hedging strategy for this, but I'll have to skip that part to thank you very much for your time, and we can discuss every question you have, of course.
Okay, then thank you very much for your presentation, Mauricio.
Thank you.
And I would like to ask all the attendants if they have any questions or comments. Yes.
Well, yes, I have one. Is that as I pointed out to you, to use this forward information
Yes.
of that makes you an insider is usually considered a criminal offense. So,
Yes.
are you able to do this without claiming attention to you somehow?
What do you mean without claiming attention?
Yes, that if you use these approaches,
Yes.
maybe the score hot or the forward.
Maybe I have to use illegal information, right?
Well, and this makes you somehow noticeable that you are doing something not really allowed.
Okay, yeah, I got you. Yeah, so yes, in fact, I can told you from the enterprise with I work as a quant now, that obviously have illegal information is extremely hard. There are many few cases, yes, where people use that information. But what we do is not only try to analyze and get the best or better information than the other ones, but faster information than the other ones. So if I see the opportunity before of the traders, I can consider that to have privileged information. That is to have better information. Nowadays, this is not only the case of having illegal information only for insider, what exactly what insider means. No, that is like an spy, an illegal spy. Now we can even buy information, but obviously that information is sometimes very expensive. If you buy information for, I don't know, Credit Suisse, JP Morgan, and this is obviously for to the scope for corporations. A single trader from his home will not have that privileged information. No? So but yes, if anyone have illegal information, could use this also.
Okay, thank you.
Thank you.
So just a comment. Well, Mauricio pointed out correctly that insider information is not necessarily illegal information, right? It can be or it can't be. But I read the other day that actually the European Union is planning to ban basically all insider information, so that if you are an insider trader, you will be forced by law to make public your insider information. So, well, the situation will be quite strange, because I don't know if the European Union can get into the head of the traders, you know, and know what they know, but something. So I mean, it's something alive, right? That the laws are now being modified, or at least these guys at the European Union plan to modify laws in order to make insider trading more difficult.
Yeah, in fact, that's interesting, because if they make you to publish your insider information, it's not insider anymore, and
right?
then you have a correction in the prices after that.
Yeah, it's a good point. Yes, but anyway, it's very difficult to force every single insider to publish their insider information. I mean, I don't know how they try to do it. They plan to do it. But
That will be very difficult.
Anyway, any other comment or question? No? Well, let me ask a quick question regarding the part of the distribution builder. Okay, this is a nice part, because I completely agree in that it's very difficult for a trader to say what it's his
utility function.
His utility function, exactly.
Yeah.
But you know, even a distribution, I mean, if you work with professional traders, yeah, I do believe they can express their preferences through a distribution. But I mean, if somehow you treat with, say, the average trader, right? Maybe they will say, okay, my preferred distribution is no risk and a lot of profit, which is really simply not possible, right? So I don't know, maybe for, say, the average trader, it would be nice to let's say translate the distribution into a few utilities, or maybe selecting a few distributions, so they can choose among these few, say, suitable distributions. So I don't know if you have thought about it, or
You know, well, first, yes, you said, as you said, is traders or companies try to model these utility functions. In fact, recently I read about that they classify, for example, the risk aversion for equity, risk aversion for commodities, and risk aversion for in every case, and they give you parameters for exponential utility functions, but I think they this is only used in average because the advantage of this distribution builder is you can model individually the risk aversion of every people. So if I understand you well, you mentioned that what happens if instead of letting them rearrange these Tretis blocks, what about if they choose distributions? That's your question. I mean distributions directly. If you show them you have a log normal distribution, or you have a normal, or you have his square, or I don't know. But well, in fact, we did that. We just say, well, let's assume that we want to consume every period with a log normal consumption preferences. We haven't performed that this distribution builder. We showed them that's an approach of or the idea behind this approach that but yeah, I don't know if I understand your question.
Yes. No. Well, my question was relating to offer the average traders something quite simple, right? So they can select between few simple options. I mean, maybe you didn't focus on that. It's possible, right? It's like, you know, when I go to a bank here in Spain, they offer you, if I remember well, 6 options, right?
Okay.
So they are rated from 1 to 6, and this, in a sense, measures the risk. So 1 means no risk, and 6 is very risky. But of course, I mean, from a mathematical viewpoint, it would be better. Yeah. I don't know how they do it actually. From a mathematical viewpoint, we need to make this precise, right?
Yes. Yes, I understand now. Yeah, well, we haven't related that in the thesis. I mean, the paper Sharp et al. They compute the from the outcomes. They show how to compute the utility function and the risk aversion, the parameter of the risk aversion they have. But yes, I don't know what scale banks use, but of course, for example, I don't know, 1 means riskless, and this is this part, this line, and they use scales, but yet it could be interesting to check the mathematics beyond that. Maybe I once I see in BBVA web page some risky assets, some investments options, but they only classify they put that this is very risk, but because the nature of the asset, not because they are measuring risk aversion parameter. So yeah, of course, would be interesting to have a computation, and in fact use this to check what is the own parameter, risk parameter of ours. But yeah, we haven't gone beyond that, or I don't know if now in my screen I don't know if who is in the floor, but if Professor Stone is still with us. I don't know if he have thought in these topics deeper.
Yes, please.
Well, I think there are different ways one can think about it, but if I take Carlos' questions most literally, well, under assumptions, so you could translate it into such a problem if you, as you already said, Mauricio, you parameterize all possible distributions by saying, for instance, we allow only log normal distributions. Then you have, of course, a two-parameter family. And the optimization problem essentially picks one of the two parameters automatically, which means one parameter is free. So if we want to think about it in terms of risk, we can think about we have control over the standard deviation of the desired log normal random variable. And now, of course, I can discretize it and say, well, instead of letting choose over all positive real numbers of the standard deviation, I just pick 6 representative values and choose the 6 values as possible choices. And then each of these choices would correspond to one risk profile for the trader to pick from.
Right. Well, thank you both for the clarification. And I have to actually ask in my bank how they do it. Yes, I'm just curious about it. But well, so I don't know if I think we have time for a last question or maybe comment. I don't know if someone else wants to add something. Okay, so no one. In this case, I thank Mauricio again, and I thank you all for attending this seminar. Okay, so well, thank you, Mauricio.
Thank you very much.
Thank you.
And well, if you want, I mean, if in the future you have some question, please feel free to contact Mauricio, because I'm sure he will be happy to answer your questions.
Yeah, of course, please do it. And thank you for your virtual applause.
Okay, so well, thank you and goodbye, everybody.
Thank you.
Bye.
Bye.